Decoupling of Lido's staked Ethereum differs from stablecoin collapse, CoinShares say. The decoupling of Ether and Lido Finance's staked Ethereum is not equivalent to the breaking of the link between Terra USD and the dollar, and isn't an example of the stablecoin collapse, according to CoinShares. Unlike a stablecoin, stETH does not have to trade one-to-one to function correctly, CoinShares wrote in a June 16th report. Moreover, because Ethereum has not enabled withdrawals from staking, there are no arbitrage opportunities to keep the price in check. Staked Ether is an Ethereum-based token representing ETH that's been staked on Ethereum's proof-of-stake beacon chain. stETH has tended to trade at a similar price to ETH because there's a one-to-one claim relationship. However, after UST lost its peg last month, stETH began trading at roughly 2% discount at the times as low as 6% discount. This is not the same as the UST crash because the underlying asset ETH is not directly affected by the market price of stETH, CoinShares says. The benefit of stETH is that it allows users to yield from staking Ether using a technique known as liquidity staking. The ETH that's been staked continues to secure the network as planned, while users have access to a liquid asset that can be invested. Lido's product can be classified as premature because the inability to unstake means stETH feature incomplete, according to the report. The Ethereum community has become concerned over the amount of power that Lido has amassed because the liquid staking derivative has around 1/3 of all staked Ether locked up in contract, CoinShares say. Since the underlying, and the problem is if Lido basically gets themselves into a financially compromised position with leverage or something along those lines, right? Since the underlying ETH is locked up and there's no planned date to introduce withdrawals, market makers like Celsius may be forced to sell their holdings to meet stETH redemptions, research analyst Mark Ajun wrote. On-chain data appears to indicate that Celsius has enough assets to match the liabilities in the event that all stETH is redeemed, but given the opaqueness and centralized entities, this is not certain, according to the report. Swissborg, BlockFi, Hodlnaut, Abra, Salt Lending, and Nexo may also have to fulfill redemptions, the note said. So once again, it's not necessarily the Lido problem, which is maintaining that one-to-one peg, but it's all of these other centralized entities that are participating within it that have customers to basically pay out, right? So your BlockFis, your Hodlnauts, Celsius, all that stuff, right? And that is where I think like a lot of people miss some of what's going on. So CoinShares says that longer-term investors who profit in losses denominated in ETH could see this as buying opportunity because stETH will become redeemable one-to-one when withdrawals are enabled. Conversely, investors with shorter-term horizons and US dollar-denominated profit and loss will probably need to exit their positions, while arbitrageurs may also be buying stETH at a discount and shorting ETH, it added. Recent updates on Ethereum testnets have been positive, which brings more confidence to those waiting on the merge and when withdrawals are finally enabled. Come on, CoinDesk! The roadmap says that you will not have withdrawals enabled post-merge. Come on, please stop, man. Ugh. But until then, there will exist some form of discount, the report said. The decoupling event will reinforce calls for regulation of lending platforms and the digital asset ecosystem in general. I hope you enjoyed this clip from the Crypto Mining Morning Show every Monday through Friday, 7:45 a.m. Pacific and 10:45 a.m. Eastern Time. You can check out more clips here, or if you're interested in checking out the entire live show, you can check that out down here. Thanks for watching, and I'll see you next Tuesday.